Okay, this is a lecture for chapter 10 for auditing. Since this is my first one, I'll just kind of warn you that I'm going to try and keep the videos fairly short, so I won't do entire chapters all at once. Instead, I'll do, pieces of the chapter. I'm trying to keep it less than 15 minutes. Some of them might be 10, just kind of depends on where the stopping point is. That way, it's easier to go back and find maybe what you're looking for. And I'll try and label the videos with either page numbers or section 1 of the chapter, section 2, that kind of thing. So with that, we're going to jump into chapter 10. Chapter 10 is about auditing cash, marketable securities, and complex financial instruments. Cash almost always is about the first thing as a brand new auditor that you happen to audit, just because it's one of the more straightforward things, and generally doing things like bank reconciliations are just kind of something I usually stick to the newest auditor with. So if you are planning on going into auditing, it's likely something that you will see day one of your first audit as far as the substantive procedures go. I'm just moving on. We'll skip the learning objectives. You can read through those. And we'll probably skip the questions for this too. Okay, so different types of cash and things that we will be auditing. We have the general checking account. This is where we have the vast majority of our transactions occurring within our organization. This is our regular place for cash receipts and cash disbursements. There are some companies or organizations that also have lock boxes. A lockbox is effectively a box at a bank that people who owe the company money can send the check directly to the bank. What this does, one thing, it takes the check out of the hands of your organization. Once it's mailed, it goes straight there. So it alleviates some internal control issues that can happen. And it also speeds up how fast the check is deposited, because it's not uncommon that you have to wait and maybe go once or twice a day, depending on how often you're receiving checks, to go to the bank. So with the lockbox, you can speed up the rate of payment. Petty cash. Remember, we've talked about petty cash account in other classes, but that's effectively a fund that we use to disperse, small amounts on a regular basis. There should not be much, and it should be just like a sufficient amount of money to pay for routine expenses. So things like you're out of an office supply that you've ordered some, but it's not going to come in for 4 or 5 days. You can run to the office supply store and grab some paper, printing paper, some pens, some anything, but it should be relatively small in dollar and value. And then good cash management includes things like balancing returns and risks on idle cash balances, moving excess cash in and out of short-term investment accounts to generate extra returns. So depending on your organization, your bank, and who you work with, it's not uncommon for companies to actually clear or have a clearing account that goes down to zero or close to zero on a regular basis, intentionally, only keeping the balance in that account that's required. It's also, by the way, another control. Only keeping the balance that's required based on the checks that have been recently written from that account. That way, your money is working for you, and you're not just letting it sit there in a checking account, earning no interest and earning nothing on it. Okay, so this is just some T accounts that show the cash cycle. You can see we have the cash element to this, obviously, but we also have sales revenue, accounts receivable, interest revenue, and other various expenses. So when you're auditing any individual part of a set of financial statements, or let's say individual account like cash and cash equivalents, that doesn't mean that you're ignoring the other elements, because like everything in accounting, there's two sides to every entry. So we would not only want to be paying attention here to the cash sales. I don't want to just pay attention to the cash. I also want to pay attention to the revenues or the accounts receivables. Same thing with collections and other receipts. So all these elements go together and should obviously come to a total, and that should be what's left in my cash. Okay, move on from there. Okay, the 5 relevant assertions to cash. By the way, I'm on page 494. Existence and occurrence. Okay, that cash balances actually exist at the balance sheet date. Generally, that's something we do with sending a confirmation to the bank directly. Remember, we talked about how that's better. It's third party and external. Completeness. Cash balances include all cash transactions that have taken place during the period, making sure that nothing is left out. Okay, if you paid somebody or received cash, that it is in the account as it should be, or the proper account. Rights and obligations. The company has title to the cash account as of the balance sheet date. For example, cash might be pledged as collateral. If this is the case, the company must disclose relevant information about the collateral arrangement. In most cases, risk related to ownership of cash is low. Generally speaking, cash is not something that's collateralized. Usually you collateralize loans or other things with something that is non-cash, because if you had the cash, if you're using cash as collateral, why not just use the cash itself rather than get a loan in the first place? So I can't say I've ever actually seen cash used as collateral. It is possible, it is an asset, but I don't recall ever seeing that myself. Valuation or allocation. The recorded balances reflect the true underlying economic value of those assets. This assertion usually has a low level of inherent risk. Why? Because cash is cash, and cash always has the same value. Now, it could be currency issues if you're an international company, but we're talking, we have our financial statements in a single currency, and in our case, usually the American dollar. So there's not usually a lot of valuation that has a problem with this. Presentation disclosure. Cash is properly classified on the balance sheet and disclosed in the notes of the financial statements. For example, restricted cash might need to be reported in the non-current asset section of the balance sheet. So restricted cash, I saw this a lot in things like not-for-profits. So when not-for-profits accept money or funds from donors, okay, if it was earmarked for a specific purpose, say building a specific building, or for a specific program, or for an investment where they can only use the interest or growth on it, those would be restricted funds. And those are labeled differently because like with every other asset, we have current and non-current assets. Well, technically there are non-current, can be non-current cash if it is cash you cannot use or has some sort of form of restriction on it. So it could be cash, actually, it could be cash in the non-current section of the balance sheet, although it sounds counterintuitive, it is true. Okay, moving on. This is page 494. This is on the bottom of page 494. Cash and cash equivalents. Cash and cash equivalents. So cash, I think, is pretty obvious what it is, but cash equivalents would be anything that's highly liquid. Anything that could be turned into cash at a relatively quick rate. This would be securities a lot of times, so stocks, bonds. But remember, we do differentiate between, excuse me, we do differentiate between, the different terms and intention to, say, hold a bond. Remember, we classify those types of investments differently. So cash equivalents is something that not only can be turned into cash quickly, but also likely will be. Certificates of deposits would be another example, money market accounts and time deposits. Marketable securities are the securities that I may or may not trade soon, and they are usually a little bit more long-term. Now, does that mean long-term as in non-current? No. Generally, most marketable securities are current, but I don't have the plan or intention to turn those into cash in the near future. And that's on page 495. Okay, on to page 497, an overview of the audit opinion formulation process for cash accounts. In auditing cash accounts, the auditor will perform risk assessment procedures, test of controls, and substantive procedures. And we're going to go into some detail about what types of controls, what types of substantive procedures. So move on from this one for now, but we will be performing all three of those types of procedures and tests within our audit of cash. Okay, we're going to skip past questions. Okay, now I'm on page 498, identifying inherent risk. Remember that cash in and of itself is an inherent risk, or has a high inherent risk because of the fact that it's cash. Because it's something that people would likely want to steal, as there's always value in cash, it has a high inherent risk in the first place. But there are other parts of cash that can lead to an even higher measurement of the inherent risk within our cash accounts. So the first one is volume of activity. The more transactions that there are, the more susceptible it is to error. Okay? It also makes it easier to commit fraud because the more transactions you have to search through, or the more transactions that there are to go through, the less likely something is to get noticed. Okay, and we'll talk about some different cash schemes that occur. Liquidity. The cash account is susceptible to theft because cash is liquid and easily transferable. That's kind of the inherent one I talked about already. Automated systems, electronic transfer of cash, and the automated controls over cash are such that if errors are built into computer programs, they will be repeated on large volumes. So this is a risk this is kind of that risk involved with using computer systems. Computers only do what you tell them to do, which means if you automate something and then you either want to stop it or it needs to be changed, If the programming is either incorrect or you didn't change it correctly when you wanted to make a change, that can cause issues. Debt covenants. Debt covenants are often tied to cash balances. Remember, examples of debt covenants are things like you have to have a given percentage of the loan balance on hand at any given time. So let's say you take out a $200,000 loan, they say you have to have 5% in cash and liquidity of some kind. That's a debt covenant. Another debt covenant would be you have enough cash on hand to cover the next 90 days of expenses. Another pretty common debt covenant. So debt covenant could be a lot of different things, but debt covenants are super important and really need to be investigated because they create a potential liability. So the debt itself is a liability, obviously, but a debt covenant, in breaking a debt covenant, that usually means that a bank, and again, it depends on the contract, but generally speaking, you mean that a bank can call that loan, effectively making you pay it all now. Say it's a 5 or 10-year loan, but if you break a debt covenant, they could say, well, we want it tomorrow. So it's a risk that we need to make sure and look into. And then misrepresentation, outright theft, again, real common because of the fact that it's cash. It's not uncommon to have that. So how do we, I'm still on page 498, it says, following are examples of questions that the auditor might ask in assessing inherent risk. We'll ask things about whether the company has cash flow problems or has problems meeting its current obligations. What are their budgeting techniques? What cash management services are offered by the bank or financial institution that they work with, and what is the nature of those arrangements? So any of these elements would all be, questions. This would be through the process of questioning management, talking to management. This would be through our analytical procedures as well, that we would utilize this in our planning phase. Questions. Okay, this should look familiar. Okay, this effectively, when we're talking about identifying fraud risk, we always have these 3 bullet points because these are the 3 bullet points of the fraud triangle, right? So incentives, obviously, generally here we're talking about management incentives, but any incentive that there is to misappropriate, steal, any type of incentive there is. Cash almost always has an inherent incentive because people want cash, right? That's not an uncommon thing or a bad thing necessarily, but it's just true. So there's obviously an incentive, an underlying incentive for cash to steal cash just because of what it is, the actual makeup of what it is. Opportunities, remember, this is the one that is best and most mitigated by effective and good internal controls. It's the one that internal controls do the most to reduce. Doesn't mean internal controls can't reduce the other 2, but opportunities is kind of the #1 thing that internal controls, a good internal control system can mitigate that risk more than the others. And then rationalization, that's the one where we talk about, okay, why does this person feel they deserve to have this money? They work too many hours, they're underpaid, they're overqualified. There's you talk to people who steal, and there's just reasons after reasons after reasons that they rationalize what they've done. They don't think something's fair. They think the boss is an evil person. They think, it just goes on forever. So that's what we mean by rationalization. So those would be the kind of things that you'd want to listen for in interviews. So if I'm interviewing somebody who handles cash and we're having a conversation, I'm asking some of these questions that we just talked about, and they keep bringing up or keep mentioning the fact that they are way underpaid and they're worth way more than they are and that kind of thing, that's a red flag that shows there could be at least that element of the fraud triangle, and then rationalizing the theft that they could be perpetrating. It's something you'd want to look into further if you heard that when you're interviewing, when you're auditing that company, when you're interviewing its employees. So some common schemes related to cash, and this is on the bottom of page 499. Employees purchase merchandise and records a sale at an unauthorized discounted amount. Employee steals cash and conceals it by recording a fictitious discount. So, if I record a discount to a customer, so they owed me $2,000, but I gave them a $500 discount, well, then they send me a check send the company a check for $2,000. I would pocket the difference of the $500 and book the other part to customer discounts. Employee writes a check to a fictitious vendor and deposits the check into an account that he or she controls that has been set up in the name of a fictitious vendor. So this one takes quite a bit of work to do, but is actually fairly common in larger organizations if there's not a good vetting process of the vendor, seeing who the vendor is, what are they receiving. This one's most often caught on the back end of if they're a vendor, if you're fictitious and you're a vendor, what are you receiving from them, right? So when that invoice comes in, what is the company getting from them? If I don't have any inventory for it or I never see it, then that's again another red flag. Skimming. Employee makes a sale but does not record it and steals the cash. The most complicated version of this involves booking the sale, deleting the sale, or reversing the sale within your organization. Probably the most common, and the one that you might see, you could see at a mom and pop shop, not that mom and pop shops would do this, but would be really easy to do, is if you've ever gone in somewhere and if they sell you something, but you don't see them ring it up in the register. Okay, that's a red flag. You don't see anything come up and ring up. You just say, okay, this is what I want to buy. They say, all right, that's $20.45, and you give them money, and they give you change back. And when I say ring up, I don't just mean hit the button. They can open the register and give you change back, right? The problem would be more in line with they would, simply open the register, not actually type in any kind of sale to show a record that it actually happened, and then just pocketing the money that they received from you. Then the sale never shows up. That's, like I said, common. This is easy to happen in things like restaurants and other, where you have a point of sale where there's individual employees. Lapping. Employee steals a payment from customer X. To cover the theft, the employee applies the payment to customer Y. This is kind of like the internal version of Ponzi scheme. So to cover the theft, the employee applies the payment to customer Y to customer X's account before customer Y has time to notice that it's not been appropriately credited. The employee applies payment Z to customer Y. So this is one that usually is easiest caught by somebody that doesn't have or doesn't take any vacations. Also, segregation of duties when it comes to receiving cash and receiving, pay up when receivables are being paid, because this one has to be continuously done in order to work. You can't really stop this. Once you've taken that first check from company X, you've got to have company Y's money to write down company X's, and then so on and so forth with Z, and we just go on in perpetuity. All right. Okay, identifying the risks of controls. First thing, we have to always obtain an understanding of internal controls for both the integrated audits and the financial statement audits. Okay, sorry about that. I'm going to stop here because this video has gone on a little bit longer than I'd wanted it to. So this is a good place to stop, and we'll start with this one on the next video, chapter 10, video number 2.